The economy looks strong, yet on January 3rd, 2025, the U.S. hit the most dangerous distortion since empires began recording financial data. Real wages fell for the 34th straight month, while household debt hit $17.5 trillion, a combination worse than 1929. Markets celebrated. That's the contradiction. Stocks touched new highs as the middle class quietly entered stage 7 of the imperial collapse cycle. History warned us. Rome's middle class evaporated 12 years before the empire fell. Britain's middle class collapsed a full decade before losing global power. And now, the U.S. is following the same pattern, only faster. Because today's structural strain is deeper than 2008, sharper than 2000, and more systemic than 1929. A new metric hit last week. 48% of Americans can't cover a $400 emergency, the worst on record. The system was already cracking. This collapse isn't speculative. This collapse is mathematical. The U.S. economy entered 2025 with record-breaking confidence. Markets were green. Tech valuations soared. Commentators repeated the same tranquil mantra. The consumer is strong. But beneath the optimism, middle-class solvency hit its worst level since 1932. That was the violent contradiction. Credit card interest rates crossed 22.8%, their highest level in U.S. history. Median real wages fell 34 consecutive months. And yet the S&P 500 celebrated all-time highs. The pattern was unmistakable to anyone who studied collapsing empires. Surface prosperity always masks middle-class erosion. This wasn't speculation. It was mathematics. Because in every empire, Rome, Britain, Spain, Ottoman, Qing, Soviet, prosperity peaked at the exact moment the middle class lost economic traction. By December 2024, household savings collapsed from 12% to 3.7%, worse than pre-2008 levels. Retail spending showed green numbers. Corporate earnings beat expectations. But Americans were financing survival through credit acceleration at rates that exceeded any peacetime period in recorded history. The numbers were worse than 1929. The contradiction deepened daily. While the Dow Jones touched 45,000, food bank usage hit all-time highs across 47 states. While tech stocks soared on AI euphoria, 61% of Americans reported living paycheck to paycheck, the highest percentage ever documented by the Federal Reserve's survey of household economics. Every empire that reached this divergence, prosperity at the top, collapse at the center, entered crisis within 15 years. Rome took 12. Britain took 11. The Ottoman Empire took 16. The pattern was consistent across millennia. The system was already cracking. Every bubble begins with the same delusion. This time is different. In 2025, U.S. valuations hit levels more extreme than any era except the 1929 peak, and by some measures, worse. The Buffett indicator, market cap to GDP, hit 195%, far beyond the 150% threshold seen before both 2000 and 2008. The Shiller PE ratio crossed 35, a level breached only twice, before the Great Depression and before the dot-com collapse. But the middle class didn't feel a boom. They felt the squeeze. Rent-to-income ratios hit 46%, surpassing the 2007 peak. Home affordability collapsed to its lowest index reading ever recorded by the National Association of Realtors. Grocery prices remained 25% above 2020 levels even as inflation metrics cooled. Gas, insurance, healthcare, every essential expense consumed larger portions of stagnant wages. The market showed euphoria. The middle class showed collapse. History was repeating in real time. In the Ottoman Empire, the middle class collapsed 16 years before the treasury defaulted. In Qing, China, inequality peaked 9 years before the dynasty fell. In Rome, wealth concentration reached terminal levels a decade before the empire fragmented. The U.S. was following the same mathematical curve. By late 2024, the top 1% held more wealth than the entire middle 60%, a concentration not seen since 1928. Stock ownership had become the defining wealth mechanism, yet 90% of stocks were held by the top 10%. The middle class owned assets that depreciated: cars, furniture, electronics. The wealthy owned assets that appreciated: equities, real estate, bonds. The system was already cracking. Valuations this high combined with affordability this low have only one historical outcome. Every empire with this divergence entered crisis within a single generation. Prosperity created expansion. Expansion created overreach. Overreach created collapse. This was stage 3 of the imperial cycle, and the U.S. was deep inside it. In 2024, the U.S. ran a $1.7 trillion deficit in a strong economy. Historical comparison? Rome did the same during its Pax Romana peak and collapsed a century later. Spain overspent during its silver boom and lost global power within decades. Military spending hit $886 billion, higher than the next 10 nations combined. But the truly catastrophic metric appeared in October 2024. Interest payments on the national debt hit $1.1 trillion annually, surpassing defense spending for the first time in American history. This wasn't expansion. It was overreach. The mathematics were terminal. Interest costs were growing at 12% annually, while GDP grew at 2.4%. When interest grows faster than income, collapse becomes mathematical certainty. Rome discovered this. The Ottomans discovered this. Britain discovered this during its 1970s debt spiral. And overreach always ends the same way. The U.S. had entered the acceleration phase. Debt to GDP crossed 123% in 2024, a level historically associated with systemic instability. Japan hit this threshold in 1995 and entered 30 years of stagnation. Greece hit it in 2009 and collapsed entirely. The pattern was consistent. Once interest costs exceed 15% of federal revenue, empires lose control. The U.S. crossed 17% in 2024. The numbers were worse than 2008. Congressional Budget Office projections showed interest costs reaching $1.6 trillion by 2028, more than Social Security, more than Medicare, more than any discretionary program. The federal government would soon spend more on debt service than on its own people. Every empire that crosses the overreach threshold loses control of its middle-class foundation. U.S. interest costs now grow faster than U.S. GDP, a terminal sign in all 6 collapsed empires. On January 3, 2025, household debt hit $17.5 trillion, the highest in world history. Yet markets celebrated. Commentators cheered. But the Fed's own internal research memo stated, debt growth exceeding income growth for 36-plus months precedes every major recession. That memo was ignored. Credit card debt crossed $1.2 trillion. Auto loans hit $1.6 trillion. Student loans remained at $1.7 trillion despite forgiveness programs. Mortgage debt exceeded $12 trillion. And all of it was growing faster than wages, a condition that guaranteed mathematical collapse. Debt-to-income ratios were worse than 2008. This was exactly how the Soviet middle class collapsed in the 1980s. Rising prices, rising debt, declining wages. It was how the Ottoman peasantry lost solvency. How the British working class drowned in credit during post-war decline. The U.S. was hitting every historical marker, only faster. Credit card interest rates averaged 22.8%, the highest ever recorded. Delinquencies climbed to 8.2%, surpassing 2011 levels. Auto loan delinquencies hit 9.1%, a record. The Federal Reserve's Consumer Credit Report showed borrowers were now servicing debt at 14.2% of disposable income, approaching the 15% threshold that preceded both 2008 and the 2001 recession. This wasn't speculation. It was mathematics. The debt bomb was structural. Average household debt exceeded $104,000, while median household income remained at $58,000. The ratio was catastrophic. Historically, when debt exceeds 1.5 times annual income, defaults cascade. The U.S. crossed 1.8 times in 2024. And then the breaking point appeared. 61% of Americans now live paycheck to paycheck, a record. Half couldn't afford a $400 emergency. 1/3 reported skipping meals to pay bills. When debt increases faster than income, collapse is guaranteed. Every empire that entered this debt trap, Rome, Ottoman, Soviet, Britain, experienced the same outcome. Middle-class disintegration followed by systemic failure. Housing is the backbone of the middle class in every empire. When housing breaks, the middle class breaks. In 2024 to 25, U.S. housing affordability hit its worst level since records began. Worse than 2006. Worse than 1981. Worse than post-war inflation spikes. The numbers were catastrophic. Median home price, $420,000. Median income, $58,000. Multiple, 7.2 times income. Historically, ratios above 5 times trigger instability. At 7 times, collapse becomes inevitable. The last time ratios reached this level globally? Japan's 1989 housing bubble, which led to a 30-year stagnation and triggered the lost decades. Sweden hit 6.8 times in 1990 and crashed. Ireland hit 7.1 times in 2007 and required an international bailout. The U.S. had now exceeded all of them. Mortgage rates climbed to 7.8% by December 2024, pushing monthly payments to $2,850 for a median home. That represented 59% of median monthly income, double the 28% threshold banks historically considered safe. Rome's middle class collapsed when housing costs consumed more than 40% of income. Today, many U.S. cities break 50%. In San Francisco, it's 87%. In New York, 71%. In Los Angeles, 68%. The system was already cracking. Rental markets offered no escape. Median rent hit $2,150 nationally, consuming 46% of median renter income. In 2019, it was 32%. The acceleration was unprecedented outside wartime. First-time homebuyer rates collapsed to 26%, the lowest since the National Association of Realtors began tracking in 1981. Millennials and Gen Z were being systematically locked out of homeownership, the primary wealth-building mechanism in American capitalism. Every empire that hit this affordability threshold entered irreversible decline. Housing isn't discretionary. It's foundational. When the middle class can't afford shelter, the economic model has failed. Mortgage rates hitting 8% pushed affordability into a zone worse than 2008. And unlike 2008, there were no subprime loans to blame. This collapse was driven by pure unaffordability, a structural death spiral with no policy solution. Stage 2 of the cycle, elite consolidation, always intensifies during crisis. By 2025, the top 10% owned 70% of all wealth, the highest concentration ever recorded in U.S. history. The bottom 50% owned 2.6%. This wasn't inequality. This was imperial-level extraction. In Rome, elite landowners absorbed the middle class during the late Republic. In Qing China, noble clans absorbed peasant land. In Britain, aristocratic consolidation destroyed upward mobility during industrial decline. The same pattern appeared in the Ottoman and Soviet collapses. The U.S. middle class was following the same curve. The mechanisms were identical to historical extraction, wage stagnation combined with asset inflation. The middle class earned income. The wealthy owned assets. And in an era of monetary expansion, assets appreciated while wages stagnated. Between 2020 and 2024, the S&P 500 gained 68%. Median wages grew 11%. Inflation ran 23%. The mathematical result: massive wealth transfer from labor to capital. Insider selling hit a 10-year high in Q4 2024, $141 billion in stock disposals by corporate executives. They were exiting at the peak. Meanwhile, retail investors poured record sums into equities, buying at valuations that preceded every major crash. The numbers were worse than 1929. Corporate buybacks reached $1.1 trillion in 2024, draining corporate liquidity into stock-driven enrichment instead of productive investment. Companies borrowed at historic levels to repurchase shares, inflating valuations while weakening balance sheets, the exact pattern that preceded 2008. Then the consolidation accelerated structurally. Private equity firms acquired over $950 billion in assets during 2024, absorbing healthcare companies, housing inventory, retail chains, and industrial firms. The middle class was being converted into renters of homes, of healthcare, of services. Once elites extract more wealth than the middle class can generate, collapse accelerates automatically. In all 6 empires, Elite consolidation preceded collapse by 10 to 20 years. Rome, 11 years. Britain, 14 years. Qing China, 9 years. The U.S. crossed the consolidation threshold in 2016. The timeline was running. In 2024, the U.S. printed $6 trillion in 4 years, the largest monetary expansion outside wartime. Inflation cooled on the surface, but the middle class never recovered. Real purchasing power fell 22% since 2020, the steepest peacetime decline in modern American history. Rome debased its silver coinage during the crisis of the 3rd century. Ottomans debased the ackee during imperial decline. Britain debased during the 1970s stagflation. The Soviet ruble collapsed under hidden inflation during the 1980s. This was the identical pattern, just modernized. The Federal Reserve's balance sheet ballooned from $4 trillion in 2019 to $9 trillion by 2022. Though it contracted slightly by 2024, the damage was structural. Money supply growth, M2, expanded 40% in 2 years, faster than any period except the hyperinflationary 1970s. The middle class paid the price. Grocery prices remained 25% above pre-pandemic levels. Energy costs stayed elevated. Insurance premiums climbed 30%. Housing, healthcare, education, every essential expense consumed larger portions of stagnant paychecks. And then the dangerous metric appeared. Interest payments exceeded defense spending for the first time ever. This was worse than 2008, worse than 1970s stagflation, worse than post-war dislocations. The structural trap was mathematical. The government had borrowed trillions at near-zero rates. Now those bonds were rolling over at 5% plus. Refinancing costs were exploding. The Congressional Budget Office projected interest costs hitting $1.6 trillion by 2028, consuming 25% of federal revenue. History was repeating in real time. Currency erosion always follows the same sequence. Monetary expansion, asset inflation, middle class purchasing power collapse, political instability, fiscal crisis, currency degradation. The U.S. had entered stage 5. The dollar remained the global reserve currency, but cracks were appearing. BRICS nations accelerated de-dollarization. China and Saudi Arabia began settling oil trades in yuan. Central banks reduced dollar reserves to 58%, the lowest since 1995. Once interest costs exceed productive spending, every empire enters irreversible decline. Inflation-adjusted wages have not recovered their 2019 level, the longest stagnation in modern U.S. history. By late 2024, multiple liquidity warning indicators flashed red. The SOFR funding stress index spiked in September. Repo markets tightened. Bank reserves fell below the Fed's comfortable minimum threshold of $3 trillion, dropping to $2.8 trillion. A leaked Fed memo from September 2024 said, liquidity strain is more persistent than pre-2008 levels. That line alone should have triggered alarms. Liquidity is the circulatory system of financial markets. When it constricts, everything fails. Rome's collapse began with liquidity shortages during the 3rd century. Britain's 1970s crisis began with liquidity freezes. The Soviet collapse began with liquidity rationing in the late 1980s. The U.S. had entered the same structural phase. The warning signs were mathematical. Treasury auctions in Q4 2024 saw the weakest demand since the 2009 crisis. The bid-to-cover ratio fell below 2.3, a level associated with buyer exhaustion. Foreign central banks reduced purchases. Domestic banks showed declining interest. The Federal Reserve was becoming the buyer of last resort. And liquidity fragility always leads to the same outcome, cascading failure. The mechanics were already visible. Regional banks showed deposit flight. Commercial paper markets tightened. Corporate bond spreads widened. High-yield debt saw reduced issuance. This wasn't speculation. It was mathematics. When liquidity stress meets debt dependence, markets seize. The 2008 crisis began with liquidity withdrawal in August 2007. The 2000 crash started with liquidity tightening in March 2000. The 1987 crash was triggered by liquidity exhaustion. The pattern was consistent. Liquidity disappears slowly, then all at once. By December 2024, overnight funding rates spiked unexpectedly. a technical red flag indicating strain. The Federal Reserve injected emergency liquidity 3 times in Q4, operations not seen since March 2023's banking crisis. Rome couldn't maintain liquidity during overextension. Britain couldn't during imperial decline. The Soviet Union couldn't during terminal crisis. The US was walking the same path. Once liquidity stress meets debt dependence, collapse becomes automatic. Treasury auctions in 2024 saw the weakest demand since the 2009 crisis, the first domino beginning to fall. Corporate America looked strong until you examined the balance sheets. Zombie companies, firms unable to pay interest from operating profits, hit 18% of all publicly traded corporations, matching the early 1980s and surpassing 2007 levels. These companies survived only through debt refinancing, perpetually rolling over obligations they could never repay. Corporate leverage ratios hit new highs. Debt to EBITDA climbed to 4.8 times across the S&P 500, well above the 3 times threshold considered safe. Commercial real estate vacancies reached 20 to 28% in major cities, triggering a wave of distressed asset sales. Rome's collapse accelerated when businesses couldn't sustain debt. Ottomans collapsed when tax farming corporations failed. Britain collapsed when industrial firms couldn't finance modernization. The US was walking through the same minefield. The breaking point was commercial real estate. Office property values dropped 35 to 40%, surpassing 2008 declines. Over $1.5 trillion in commercial mortgages faced refinancing between 2024 to 2027, at interest rates triple their original levels. Then came the shock metric. 40% of small businesses couldn't cover rent in November 2024. The system was already cracking. Small business failures accelerated. The closure rate hit 12% annually, the highest outside recession. Retail bankruptcies climbed. Restaurant chains filed Chapter 11. Regional commercial developers defaulted. Corporate fragility was systemic. Investment-grade corporate debt hit $7.8 trillion, much of it issued during the zero-rate era. Now companies faced refinancing at 6 to 8% instead of 2 to 3%. The interest burden was crushing. A Goldman Sachs internal memo warned, corporate default risk is approaching 2008 levels despite surface stability. The middle class didn't see corporate balance sheets, but they felt the consequences: layoffs, reduced hours, wage freezes, benefit cuts. Corporate fragility always cascades downward. Zombie companies can't invest, can't hire, can't raise wages. They exist in stasis, consuming capital while producing nothing. At 18% of all firms, they represented a systemic dead weight dragging down productivity and growth. Corporate fragility combined with debt dependency creates the domino that starts the end. Office property values dropped 35 to 40%, surpassing 2008, and the defaults were just beginning. This is where the collapse becomes irreversible. Stage 7. Social fracture and institutional distrust. And the US is already here. The metrics were catastrophic. Trust in Congress, 13%. Trust in media, 18%. Trust in banks, 27%. Trust in elections, historically low and declining. Rome fell when civic trust evaporated. Britain declined when the working class rejected institutions. Qing China collapsed when peasants lost faith in the imperial court. The Soviet Union dissolved when citizens lost trust in the party. The same mathematical threshold had now been crossed. Pew Research documented the collapse. Trust in government fell from 73% in 1958 to 16% in 2024, the lowest ever recorded. Trust in financial institutions dropped from 53% in 2004 to 27% in 2024. Trust in major corporations fell to 18%. The middle class had stopped believing the system worked for them. And they were correct. Wage stagnation, housing unaffordability, debt dependency, healthcare costs, education costs. Every structural pressure confirmed their instinct. The system had been optimized for extraction, not prosperity. Political fracture intensified. Partisan polarization reached levels not seen since the Civil War era. Congressional gridlock prevented functional governance. Courts became politicized. Media fragmented into tribal echo chambers. Social cohesion disintegrated. History was repeating in real time. When institutions lose legitimacy, Empires lose the capacity for collective action. They can't reform, can't adapt, can't respond to crisis. Then the final metric appeared. 52% of young Americans reported they no longer trust U.S. capitalism. The system had lost the next generation. In Rome, youth disengagement preceded collapse by 8 years. In the Soviet Union, youth cynicism appeared 5 years before dissolution. In Britain, working-class youth rejected the system during the 1970s, and the empire never recovered. The U.S. had crossed the same threshold. No empire recovers once the middle class stops believing in its institutions. Trust is the invisible architecture of civilization. When it collapses, everything else follows. The collapse was no longer economic. It was existential. Collapse begins with a trigger. It always looks small at first. A bank failure, a liquidity freeze, a bond auction gone wrong. Rome's trigger, tax revolt and liquidity shortages during the 3rd century. Britain's trigger, insolvency crisis in the 1970s. Spain's trigger, sovereign debt collapse in the 1550s. The Soviet trigger, budget crisis and currency implosion in 1991. The U.S. trigger will be debt-driven. Because interest costs rising faster than revenue is the final mathematical red line. In Q4 2024, the warning appeared in Federal Reserve meeting minutes. Current trajectory shows interest costs growing 25% annually, while tax revenue grows 6%, an unsustainable divergence. This is the trigger. The mechanics are mathematical. The U.S. must refinance $8 trillion in Treasury debt between 2025 to 2026. Most of it was issued at 1 to 3% interest during the zero-rate era. Now it rolls over at 5 to 7%. The interest cost explosion is automatic. By 2026, interest payments will exceed $1.4 trillion annually. Larger than defense, larger than Medicaid, larger than all non-defense discretionary spending combined. The numbers were worse than 2008. When interest consumes revenue faster than growth produces it, governments face 3 options: cut spending, politically impossible; raise taxes, economically destructive; or print money, inflationary spiral. The U.S. has no good options. Historical precedent is clear. Spain defaulted 9 times between 1550 to 1650 as interest costs exceeded revenue. Weimar Germany printed to cover obligations and triggered hyperinflation. Greece was forced into austerity when markets refused to refinance debt. The U.S. trigger will likely appear as a failed treasury auction, a moment when buyers refuse to absorb new debt at offered rates. It happened to Britain in 1976, to Greece in 2010, to Argentina repeatedly. Once interest costs exceed revenue growth, collapse timing becomes mathematical, not political. Treasury refinancing needs hit a record $8 trillion for 2025 to 2026. The auction calendar is packed. The buyers are exhausted. The trigger is loaded. This is where collapse becomes visible. The middle class fractures. Consumption falls. Defaults rise. Historically, this phase is irreversible. Rome's middle class abandoned cities during the 3rd century crisis. Britain lost manufacturing during the 1970s decline. Spain saw mass immigration during the 17th century collapse. The Soviet middle class lost purchasing power in months during 1989 to 1991. The signs were already appearing in the U.S. Credit card delinquencies at 8.2%, highest since 2011. Auto loan delinquencies at 9.1%, highest in history. Student loan delinquencies rising post-restart. Savings rate below 4%, historically recessionary. This wasn't speculation. This was mathematics. The breaking point comes when the middle class can no longer sustain consumption. And U.S. consumption drove 68% of GDP. The entire economic model depended on middle-class spending. But the middle class was out of capacity. Debt maxed. Savings depleted. Wages stagnant. Credit tightening. Retail sales began showing cracks in late 2024. Discretionary spending declined. Restaurant traffic dropped. Travel bookings slowed. Black Friday sales disappointed. Holiday spending came in below expectations. The economy was consumption-dependent, and consumption was failing. When the economic center collapses, the empire collapses behind it. The cascade is automatic. Consumption falls, corporate revenue declines, layoffs accelerate, unemployment rises, consumption falls further. By January 2025, the first major retailer filed bankruptcy. More followed. Regional banks with commercial real estate exposure showed losses. Corporate earnings warnings multiplied. Then the devastating metric confirmed the breakpoint. 48% of Americans see and cover $400 emergency, the most alarming metric in U.S. history. This was the middle class breaking point, not future risk. Present collapse. Rome collapsed when the middle class lost economic function. Britain declined when the working class lost purchasing power. The Soviet Union dissolved when the middle class ceased to exist economically. The U.S. had reached the same threshold. The middle class economic model had failed. This is stage 8, the final stage, the breakdown every empire reaches after middle class destruction. Rome collapsed into regional fragmentation, lost central authority, entered the Dark Ages. Ottomans, dismantled by financial insolvency, partitioned by external powers. Qing, overtaken by internal revolt combined with external pressure, dissolved entirely. Britain lost global dominance, experienced decades of decline, never recovered empire. Soviet Union dissolved completely within 2 years of middle-class economic collapse. What does Stage 8 look like today? Institutional failure, financial volatility, currency decline, social destabilization, wealth polarization reaching structural breaking points. The U.S. had entered the acceleration phase. By 2025, every systemic indicator pointed toward cascading failure. Debt exceeding sustainable levels. Interest costs exceeding revenue growth. Middle class solvency destroyed. Corporate balance sheets fragile. Liquidity strained. Political trust collapsed. Then comes the final metric. Debt to GDP projected to hit 130% by 2033, a level every previous empire passed only once, right before collapse. The Congressional Budget Office projection was unambiguous. Under current policy, debt would reach 166% of GDP by 2054. But collapse never waits for long-term projections. It arrives when structural breaking points converge. The system was already cracking. History shows the endpoint. Rome fragmented. Britain declined. The Ottomans were partitioned. Qing China collapsed into chaos. The Soviet Union ceased to exist. The U.S. wouldn't disappear geographically. But the imperial economic model, dollar hegemony, middle-class consumption, global military dominance, institutional legitimacy, was approaching terminal failure. The mathematics left no alternative. Every empire that reached stage 8 experienced the same outcome: systemic breakdown, loss of global position, internal restructuring, decades of adjustment. The U.S. has entered the final mathematical phase shared by all collapsing empires. No empire in history has ever reversed a stage 7 to 8 transition. None. The pattern is mathematically consistent across millennia. Debt to GDP rising faster than national income has preceded every imperial collapse on record. The United States just crossed that line.